Hi, welcome to Breed. My name is Mariana. I'm one of the partners here. I'm very proud to say that we are a family business with national reach. We have agents in different parts of the country and we are independent and exclusive buyer's agents. So we work just for you. So in this video, we want to talk about mortgage interest rates, and it's more than just sharing knowledge. It's explaining to you how you need to position yourself in order to negotiate and make the best decisions. So here in this, TAG is your APR, 10 is your interest rate. So the spread with the insurances and other fees combined with your Euribor, the European fee that fluctuates based on the market, this will be your APR. Just the interest rate is your spread, which is the bank profit, and the Euribor. So when you include the insurance, it makes this number a little bit higher. And we negotiate the insurance, we shop around to get you the best insurance and rates in order for you to get the lower APR, meaning TAG here in Portugal. So I will show you here, this is Santander, one of the banks that we work with. The bank profit spread is 0.5 if you go variable. The interest rate is 4.4, the APR 5.3 up to 6.6. And then you have the mixed rate, and then you have the fixed rate. And based on each of these, they have different campaigns, and you can choose the other one, BPI, one of the banks that we also work here, the TAG, which is the APR, the higher amount, is 4.4%. Then you have Novo Banco. Here, their rates are really high, but don't think that Novo Banco is worse or better. It's just that we need to analyze each situation. So in this simulation that I created here, the spread is 3%. But if you go with their campaigns, you can get 2.4%, for example. But this is the bank profit, so we want the lowest rate, right? And then the TAG here is really high, 8.2%, because the spread is really high. So you will see that if you buy bank products, then this will go lower and lower. If you go to Bank of America in the US, you will have the interest rate that, if you do fixed for 30 years, 6.8, APR 7.1. And then if you go to Wells Fargo, again, this is in the US, interest rate 6.3, APR 7.3. HSBC in UK, you have the APR 6.8, and of course if you go for fixed rate, it will go lower, just like in Portugal. In Canada, you have 5.64% 3-year fixed rate, and then you have the variable rate, and then 5 years. So it's kind of the same if you think of the terminology, but Portugal, if we can shop around the insurances, we can bring your APR lower, which is your TAG, and if we can negotiate and create like a bidding war between the banks, then we are able to get the best bank profit, which is the spread. The Euribor is something that fluctuates. 2 years ago, we had this negative, meaning that it would be the bank profit would be 0.85%, and being negative would push this down. So we are talking about an interest rate lower than 1%. This is 2 years ago. So with the market, all the countries went up, and so Portugal followed because of the Euribor fee went up. Then it reached a peak and now it's going down. So the banks want you to be fixed in a fixed rate because this is where the peak is. So if you fix yourself here at a high rate, then when it goes down, you're still paying the bank here, so their profit is higher. So you need to consider it because it's going down, but the market fluctuates. So we need to check the forecast and see how this is going. Depending on when you watch this video, it's important for you to consult with us. You can click on our website and request a complimentary consultation. We only ask you to fill out a form so we can get to better know you before the meeting, so we save time. And then if you have questions about this and any other thing related to buying a house in Portugal through a buying agency, you can leave your comment here and we'll be glad to help you.